Good evening. I'd like to start this evening by acknowledging that I work on the land of the people of the Kulin Nations, and I'd like to pay my respects to their elders past, present and emerging, and also acknowledge the traditional custodians of the land on which you are situated. My name is Pip Nicholson and I'm the Dean at the Melbourne Law School, and it's an extraordinary pleasure to welcome you tonight to the inaugural Anne O'Connell Distinguished Tax Lecture. You will shortly hear from our guest speaker, the Honourable David Bradbury. Following the lecture, there'll be an opportunity to ask questions, and they will be chaired by Sue Williamson, partner at Holding Redlich. Sue also teaches in the Master of Laws programs at the MLS and is a member of the Commissioner of Taxation's Remedial Powers panel and a former president of the Tax Institute. A warm welcome to you, Sue. But before I move to make a few comments about Professor O'Connell and welcome David Bradbury, I need to cover off on a few housekeeping matters. Just so you know, the chat function has been disabled, and so those of you who wish to ask queries of our guest speaker, and I very much encourage you to do so, please use the Q&A function. This evening's proceedings are also being recorded and they'll be available through our website shortly. Can I now turn to make some preliminary comments about and some background about Professor Anne O'Connell's career. This is the inaugural Anne O'Connell Distinguished Tax Lecture, and I beg your indulgence to make these celebratory comments around Anne's contribution to the school and also to the development of the law of taxation. Many of you may know Anne as a distinguished academic, practitioner and advisor, specialising in taxation law, who has published widely on taxation of charities, of superannuation, on tax avoidance and also on capital gains tax schemes. Those of you, and there may indeed be some of you in the audience who were Anne's contemporaries at this law school, may also recall that Anne holds an LLB honours and a Bachelor of Arts honours and a Master's by thesis from this university. She's also admitted as a barrister and solicitor of the Supreme Court of Victoria. What many of you may not know is that Professor O'Connell is the second longest serving member of the Melbourne Law School, having taught at MLS for 40 years. Professor O'Connell's leadership and impact in the area of taxation law is profound and long-standing. As director or co-director of MLS's tax group from 2006 to 2016, Anne has been integral in securing MLS's reputation for impactful policy and regulatory work. She also worked to establish our world-class Master of Tax Specialist tax law degree, a program in which many of the audience may have either been students or indeed contributors. And she has, as a scholar, contributed a great deal of research and time working to see the reform of taxation law across a range of critical issues. Having taught in tax since 1990 at the law school, Anne was also instrumental in establishing in 2016 our Women in Tax Scholarship. But let me turn and reflect briefly on Anne's contribution to the school. She has held faculty leadership positions as Associate Dean and also sitting on our executive, offering counsel and stewardship as we develop the school over time. But another key feature of Anne's contribution that came to me as I was reflecting on her contribution earlier this week is the way in which she has sought to bring the academy closer to the profession. Over her years with us, she has initiated the Harold Ford Memorial Lecture, the Supreme Court Commercial Conference, and also the Judges and Conversation series, which we still host with the Federal Court of Australia. But Anne has also been a keen teacher and advocate for our students, teaching across near 30 different subjects, I think 29 when I last counted, across 3 programs, the LLB, the Juris Doctor and the Masters. She's taught at Melbourne, and she's also taught in London at the Law School Centre for Transactional Law Studies program. And most recently, she spearheaded, together with Amanda Whiting, the publication of Legal History Matters, which saw outstanding research generated by our students published. And I thank Anne for that initiative. Perhaps what is well known by the tax community is Anne has concurrently held legal practice and advisory roles, including a special counsel at Allens, as that firm is now known, from 1996 to 2018, a member of the working group established by the Assistant Treasurer in 2012 to consider the tax concession for the not-for-profit sector, and has worked as an advisor to the OECD Paris on several occasions, including most recently in 2020. Anne has also advised government and various agencies on tax avoidance legislation, employee share schemes, and her current public offices include as a member of the advisory panel to the Board of Taxation, member of the Australian Tax Office Public Rulings Panel, and the General Anti-Avoidance Rule Panel. And since 2019, Anne has served as a senior member part-time of the Administrative Appeals Tribunal. I thank you, Anne, for your service to the school and to the development of the law of taxation, and I'm delighted to host this series for the next 3 years. I hand now over to Anne, who has indicated she would like to say a few words in reply. I welcome you, Anne.
Thanks very much, Pip. I just wanted to say a few words. I wanted to thank the Dean and the Law School for establishing this lecture series. It's a great honour to be the first woman to have a lecture series named after them, especially while I'm still alive. And I'm sure I won't be the last. There are so many young and not so young women coming through who I'm sure will have this honour as well. I'll certainly miss Pip. We've worked together in many capacities, and my other colleagues, but mostly I'm going to miss the interaction with bright young students. It's one of the joys of being an academic, and so that's something that has hit me now that I'm retired. I also wanted to say that I'm delighted that David has agreed to give this lecture. He's an incredibly busy person and has just mentioned that he's had a very hectic year. He had a great contributing role to tax as Assistant Treasurer, and I believe that his move to Paris was a great loss to politics in this country. Having said that, on the bright side, his move to Paris means that there is somebody with a great enthusiasm and intellect leading global tax policy. Because I won't get an opportunity later, I wanted to thank Sue Williamson for agreeing to chair the question and answer session. I worked with Sue when she was a partner at Allens, and I was reflecting today that she was probably the first female tax partner in a large law firm in Australia. She was also inspirational. Since I've known her, she's taken on many leading roles in tax and tax education. So I thank her for that as well. And just finally, I wanted to thank Dorothy and Emily for their organisation of tonight's event. I'm very much looking forward to it. And so I'll hand back to you, Pip.
Thanks very much, Anne. Now it is an extraordinary pleasure to introduce our guest speaker for this evening, David Bradbury. As Anne's indicated, David's located in Paris, and he's there as the head of the Tax Policy and Statistics Division of the Centre for Tax Policy and Administration at the OECD. In this role, David leads a team of economists, lawyers, and statisticians to provide economic analysis and tax policy advice, as well as comparative tax data. David was a key contributor to the delivery of the OECD G20 Base Erosion and Profit Sharing Project and its implementation. He's part of the OECD team currently working with members of the Inclusive Framework on Base Erosion and Profit Shifting as part of global efforts to secure a consensus-based global solution to the tax challenges arising from the digitalisation of the economy. Prior to joining the OECD, David was a lawyer, a member of the House of Representatives in the Australian Parliament, as Anne mentioned, and served in ministerial office, including, as Anne mentioned, as Australia's Assistant Treasurer with responsibility for tax policy. David, I'm truly honoured that you found the time to be with us tonight to deliver the inaugural Anne O'Connell Distinguished Tax Lecture, and I now hand over to you.
Well, thanks very much, Pip, and thank you to Anne for your lovely comments earlier. Very much appreciated. But can I say that it really is a great honour for me to be able to deliver this inaugural Anne O'Connell Distinguished Tax Lecture. And it's both an honour professionally, but also on a personal note, as someone who has had a great deal to do with Anne over the years, it really is a great honour to be asked to do this. Now, firstly, before I launch into the lecture itself, I want to take the opportunity to thank and to acknowledge the efforts of Melbourne Law School in creating this lecture series, because I think it's a wonderful initiative and it's something that is really excellent recognition of the contribution that Anne has made over many years as a teacher. 40 years of teaching is a lifetime of teaching, a significant contribution to imparting skills and knowledge to so many students over that time. But as Pip said, I think something that really stands out to me about Anne's contribution has been the way it has traversed the private, the academic and the government sectors. Anne is both a teacher, a scholar, but also a practitioner. And she has been someone that has lent her skills and capabilities, generally without much or sufficient remuneration for doing so, in supporting governments where they have called upon the expertise of others through a range of advisory and expert panels. And I know that very well because I actually was one of those ministers once that called upon Anne in asking her to be involved in the tax concessions working group back in 2012, 2013, when I was the Assistant Treasurer. And that was to advise on general issues around taxation of not-for-profit entities, but with a focus on those tax concessions. And I have to say it was a wonderful report. And I recall some of the recommendations were excellent. But as is often the case with these things, the report arrived just as we were about to have an election. And these are rarely the best moments in time to have some of the sorts of difficult policy conversations that often detailed analysis and good policy recommendations might require. So that was unfortunate in one sense, but with someone with a political background, that's one of those things that unfortunately I have come to expect and to understand. I can also say that it has been a real pleasure for me to work closely with Anne since then. And I have called upon her on a number of occasions to act as a special advisor to the OECD. In the first instance, a number of years ago, we were advising the Colombian government. In fact, the Colombian finance minister had asked us to assess the tax system generally, but in particular with a focus on not-for-profit entities. And when I was thinking about who we might be able to draw upon worldwide, Anne O'Connell was one of the first names that came to mind. And it was a great pleasure to be able to work closely with Anne on that work. And then more recently, we were approached by the Geneva University, their Centre for Philanthropy, and they had asked us to undertake a fairly significant piece of work on taxation and philanthropy. And that was something where once again we called upon Anne to make a significant contribution as part of the delivery of that report, which I think is a really good report that's available online if anyone's interested, and really is one of the first comprehensive assessments across a large number of jurisdictions of the way taxation and philanthropy interact. So I've had a great deal of experience in working with Anne. I know how good she is. She is incredibly strong as a policy maker. She's published widely, we all know that. I also had the privilege of being involved with the launch event of her Taxation of Charities and Not-for-Profits book, which is really becoming, I think, one of the seminal texts in that area, and is to some extent a culmination of many, many years of experience and research in that area. So it's a wonderful pleasure for me to be here today. On top of all of that, I must say that Anne is just a wonderful all-round person, and that makes a difference. But in addition to that, I want to also acknowledge that I think she's been a trailblazer and a mentor in particular to many other young women over the years. I saw that firsthand when she worked at the OECD, and I also found her to be a really strong, positive and constructive advocate of how some of the hidden forms of discrimination that can prevail need to be confronted and addressed. And sometimes a gentle discussion around some of these issues is the most effective way. And I certainly saw Anne achieve much change in that respect as well. So really great honour to be here and to be able to speak and deliver this inaugural Anne O'Connell Distinguished Tax Lecture. Now, in terms of the lecture itself, what I'd like to do is to tell a little bit of a story, if you'll indulge me. It's going to be a story of what has occurred really over the span of almost the last 10 years in terms of international efforts to make progress on base erosion and profit shifting and to reform the international tax rules. And I want to do this because I do feel particularly privileged to have been given the opportunity to be involved in many of those discussions and to also be very close to many of the negotiations, the discussions and the action that has seen that journey arrive at what has been a fairly momentous point in time that we witnessed earlier this month, when more than 130 jurisdictions across the globe have agreed to a framework, a statement for the reform of the international tax rules. And this has been a significant breakthrough in terms of reaching consensus, that consensus-based solution that Pip referred to in my CV. This has been a significant step forward. There's still more work to be done, and we're hoping to finalise an agreement by October this year. But I think it is worth telling the story of how we got to the point that we're at. And for my part, it's one that, as I said earlier, it's been a great privilege to have had a bird's eye view of that throughout. So I'd like to take us back for a minute to some of my first reflections on these issues. As Pip had mentioned, I had been a tax lawyer, so I was very much immersed in many of the issues that I now deal with on a daily basis. That was before I entered Parliament. But back in 2012, as the Assistant Treasurer, I had spent several months interrogating these issues of cross-border international tax avoidance, with a view towards wanting to enliven a domestic debate in Australia. And in November of 2012, I gave an address to the Institute of Chartered Accountants of Australia, as they were then called, and that was at the Hilton Hotel in Sydney. And I remember in that address that I focused in on what I saw to be some of the more egregious instances of cross-border international tax avoidance. And I specifically named a couple of companies at the time, which was something uncharacteristic of me or holders of the Assistant Treasurer's Office. But I also drew attention to a number of structures, and I recall very well the double Irish Dutch sandwich structure, which sounds very colourful, not so delectable as far as I'm concerned, but it sounds very colourful, and indeed was almost an off-the-shelf type of tax planning arrangement that many multinationals had been engaged in. And I, in that speech, indicated that I thought this was a discussion that the country had to have, and then ultimately it would be a discussion that the global community would have. Now, unknown to me, at the same time in the OECD in Paris, on the other side of the world, there were very vigorous discussions occurring behind the scenes that had been occurring over a period of time to try and create a basis for a program of work that would bring countries together to try and address some of these issues. And in 2013, it was the OECD's action plan on base erosion and profit shifting that was officially launched and then endorsed by the G20 finance ministers and the G20 leaders. And that was really the beginning of what we now call the BEPS project, the Base Erosion and Profit Shifting Project. Now, for my part, I also was very pleased to be involved in delivering a budget in 2012-13 under the leadership of the then Treasurer Wayne Swan, where I had been given a fair degree of autonomy to explore the development of an anti-base erosion package. And we implemented that. Of course, the elections occurred in 2013, and much of that legislation I was not able to implement through the Parliament. But I'm very pleased to say that even though there was a change of government, many of those reforms were ultimately implemented and became the national policy in Australia, even under a government of another persuasion. So that was all happening in Australia, but the OECD had picked up the cudgels and with the support of the G20 was advancing this work. Now, of course, in 2013, there was an election, and these are untimely events as far as I'm concerned. I, as the local member in the marginal electorate of Lindsay, I was unfortunately unsuccessful. Clearly, the constituents of Lindsay had decided it was time for me to go on and play a role at the OECD. Perhaps not, but certainly that was one of the outcomes of this. After having essentially lost my job, no longer being a member of Parliament, I spent a little bit of time reflecting upon what I might be able to do next. And I was very fortunate that around that same time, a post at the OECD became vacant. And over the ensuing months, I applied for that post and was ultimately successful. And I still recall in March of 2014, getting a phone call from Pascal Saint-Amand, who continues to be the director of the Centre for Tax Policy here at the OECD. And Pascal said, we'd like to offer you the job. The only catch is we'd like you to be in Paris within 3 weeks. And so leaving my wife and the 4 children behind temporarily, I quickly got my visa, relocated to Paris, and within a matter of months, the family had relocated to join me. But I found myself immediately immersed in this project, the Base Erosion and Profit Shifting Project. And I was given some specific responsibilities, in particular around the measurement and monitoring of profit shifting activities, Action 11, because the BEPS action plan had 15 action items, and Action 11 was one of them. And so I threw myself into that and have been working on this project in one shape or form throughout that time since at the OECD. Now, I have to say the journey from there to today has been a long, sometimes difficult, and sometimes challenging, but always very interesting and exciting pathway. I'd like to just share a few of the twists and turns with you to give you a little bit of a sense of how we managed to get to where we are today. So the BEPS project launched in 2013. We worked intensively over the next 2 years and delivered the reports that related to those 15 action items. And there were many achievements in that package. For my part, I think that the country-by-country reporting standard, which was developed, bringing greater transparency to the cross-border activities of multinationals, allowing tax administrations to better understand the planning and structures that multinationals have in place. I think that was a major achievement. But there were many achievements. Action 5 on harmful tax practices to address some of the difficulties associated with patent boxes at the time, efforts to combat treaty shopping. And I should say that the measures in the 2015 package ended the double Irish-Dutch sandwich. So I was particularly pleased to see that an issue that had riled me up just a few years earlier, that we were able to reach agreement multilaterally to get countries to dismantle these arrangements. Now, because of some transitional arrangements, that didn't actually happen for a few years more, but I'm pleased to say that the double Irish-Dutch sandwich is no more. So that was one element. Now, one area of the BEPS action plan was Action 1. It was Action 1 because it was seen to be at the heart of these issues. And Action 1 was about the digital economy, taxation of the digital economy. And there were many good outcomes that came from that work, in particular in relation to VAT and GST. And Australia has been one of the leading nations in implementing best practice to allow the neutral taxation of cross-border supplies in a way that taxes digital suppliers in the same way as brick and mortar suppliers would also be taxed. And there were some very good outcomes that came out of that. But on the question of the corporate income tax, this really central question of the seemingly outdated nature of the international tax rules that relied on notions of physical presence in the context of a highly digitalising global economy. That key question, to some extent, remained unaddressed. And I think many of us working on this project were very proud of what the BEPS project delivered, but we're also disappointed we couldn't quite get there on Action 1 and the digital question. Now, one of the key findings in that work was that you cannot ring-fence the digital economy because the economy is becoming digitalised. And yes, you can look at a handful of tech companies and say that that's digital, but really the whole economy is becoming digitalised. But as it was, operating through a consensus-based process, there was no consensus to tackle this question at that time. So we came out of the BEPS project very pleased with the progress made, but knowing that there was still more work to be done. At the time, the G20 said, well, this has been great work. You've been working OECD countries, G20 countries together, which I think at the time was around 44 countries, reaching common agreement. But the G20 said, but how do we ensure global implementation? And the answer to that was, we want the OECD to go away and to build a more inclusive framework, a more inclusive structure. And so we did. And then by the time we got to the 2016 June meeting that we held in Kyoto, in Japan, in Kyoto, we launched the inclusive framework on BEPS. And at that time, it had around 82 members. So we went from the 44 to the 82. And that has been a body that has been open to countries well beyond the OECD and G20. And in fact, today, the inclusive framework has 139 member jurisdictions. And that figure is likely to continue to grow over time. But that has ensured that we are now operating through a platform that has broad-based multilateral contributions and input, all members participating on an equal footing. Now, once established, one of the key initiatives that the new inclusive framework had identified was it had asked the Task Force on the Digital Economy to present a report by 2020 on the outstanding issues of Action 1. This is the big question around the corporate income tax and the digitalisation of the economy. And we were asked to deliver an interim report by the end of 2018. Now, at that time, I was very pleased to be given responsibility for managing the OECD Secretariat's dealings with the Task Force on the Digital Economy, which is comprised of all of the delegates from the member countries. So I had the privilege of leading that work at the Secretariat level, and we set about doing that work. And then the Germans took over the G20 presidency in 2017, and at the time, they said, well, this is an urgent issue, and we want you to come back with that interim report, not by the end of 2018, but by the middle of 2018. And in fact, they had asked for the report by April 2018, and we, what at the time we thought was quite remarkable, delivered it in March of 2018. But what that report did was, it was the first time bringing all of the inclusive framework members together that we reconsidered this question. And even though at that point there was no agreement on the way forward, we made some important breakthroughs. And the important breakthrough was that there was a recognition across all members of the inclusive framework that the international tax rules, particularly those that were anchored in this notion of physical presence, needed to be reviewed. And that meant that there would need to be a review of the nexus rules and the rules around profit allocation. Both of these elements had traditionally involved notions of physical presence, and there was a recognition that needed to be reviewed with a view towards delivering a final report by the end of 2020. So from then, a series of steps, we had a policy note that identified a two-pillar possible solution in January of 2019. We followed that up with a program of work setting out the detail of what we were going to do up until the end of 2020, and we released that in the first half of 2019. And then we set about trying to reach global agreement on these new approaches, or a new solution, a solution to this problem. Now, of course, the pandemic struck. That meant that our negotiations could no longer occur in person, which had a big impact, to be honest. One of the extraordinary things has been that for the OECD team and the delegates representing countries, in the period of the last 18 months or so, negotiations have been conducted from corners of our respective apartments and houses all around the globe, and have been done virtually. But the pandemic slowed down the ability to reach agreement. The other issue was that as we were approaching the end of 2020, the US elections created a situation where there was some uncertainty, and it was increasingly clear that no agreement could be reached prior to the end of 2020. And so a decision was taken, and the G20 extended that deadline until the middle of 2021. Now, I have to say that we watched on as the events in the US around the presidential election occurred, really not knowing whether the impact of whether the result would have any particular impact or not, but waiting for that to occur so that negotiations could resume. As it turned out, the new Biden administration has really thrown a huge amount of support behind these talks, and that has required some resetting of the approach that we had outlined, and we set out in much detail some blueprint reports, one on Pillar 1, one on Pillar 2, and a detailed impact assessment that my team was involved in producing. We released that in October of 2020, knowing that there would be no consensus-based solution by the end of the year. But early this year, with a new administration in place in the US, with some very definite views on ways in which Pillar 1 should be altered, we set about renegotiating and redesigning Pillar 1, and the new US administration also, I think it's fair to say, brought a higher level of ambition in terms of Pillar 2. Now, Pillar 1, of course, involves a reallocation of taxing rights. Pillar 2 involves something that is becoming known as a global effective minimum tax. And as the work has continued and the negotiations continued, as I mentioned earlier, in July this year, more than 130 jurisdictions have signed on to a statement where there is an agreed set of parameters for a final agreement to be hammered out between now and October. And that is the work that we're currently involved in. Now, I would like to just spend a few moments to talk about what that work involves. Before doing so, I should acknowledge that there are a small number of countries within the 139 member jurisdictions of the inclusive framework that did not agree to that statement, and we continue to work closely with them. But all G7, all G20, all of those countries are included in the agreement, and it is likely that if we can continue to reach a final agreement with a critical mass of countries and jurisdictions of the nature that we have already seen, then this certainly augurs well for us being able to come up with a final set of agreements that can then be implemented over time. So just briefly, what is it that was the subject of that agreement? Well, on Pillar 1, as I said, this is about a reallocation of taxing rights. So it's a recognition that we used to, still do, allocate taxing rights to nations based on where the physical presence of firm activity occurs. Now, in recognition of the fact that in the digital economy, and we all have seen this very much in the last 18 months, that a firm can have a huge presence in a jurisdiction and make a huge amount of profit even in a jurisdiction and have no physical presence. So reforming the rules to ensure that taxing rights are allocated to jurisdictions where we have customers and we also have users in the case of highly digitalised firms has been an important priority. And what has been agreed is a few things. That for the largest and most profitable multinationals, that they would be in scope of this new Pillar 1 arrangement, and a share of their global profits would be allocated to jurisdictions based on the markets that they serve, and new taxing rights would be established in those jurisdictions. Now, this is a hugely significant change for a few reasons. Firstly, for the first time, really, we consider a multinational enterprise as a consolidated group, not just as separate entities. Now, that's a massive step forward, a massive change. The second thing is that we determine the allocation of profits based on a formula-based calculation. And that is really the first time that we look to implement a formulaic-based assessment of how profit should be allocated. And I think the third and really significant thing here is that we are creating a nexus in jurisdictions where sales exceed a certain threshold. So sales, not physical presence, but sales in a jurisdiction can trigger a nexus which gives the taxing right to that jurisdiction. And that level of sales in most countries will be 1 million euros. But in smaller markets, those that have a GDP of less than 40 billion euros, in fact, will have a threshold of 250,000 euros. Now, this will mean that really for the first time, we will see some of the most profitable and the largest multinationals in the world under this new arrangement and allocating taxing rights and delivering tax revenues to jurisdictions all around the globe in a way that I think countries, whilst not all countries are happy with all aspects of where the direction that the negotiations have been going in, there has been compromise around this. And this will be significant. On the current, the question is whether it's 20 to 30%, and that's still to be negotiated, of profits to be reallocated. But even at 20%, we estimate that that will lead to somewhere in the order of around 100 billion US dollars of profit being reallocated and taxed in different jurisdictions. So this is a significant change. Pillar 2, which involves a minimum effective tax rate, and the negotiations have been centred around a figure of at least 15%, which is, I think, a higher level of ambition than where we were 6 to 12 months ago. This, I think, would be a game changer in terms of really eliminating the raison d'etre of tax havens. And I think it would wipe out the tax haven in its effect, because the rules, even if not implemented by every jurisdiction, will allow countries to top up the tax to that minimum rate, even if another country is not exercising their primary taxing right. And the way these rules work, not all countries will have to implement, but it will effectively increase the level of tax that companies are paying in all jurisdictions. This will be applied on a jurisdictional basis, and it will not be a statutory rate, it will be effective rate. And this will have a really significant impact if it can be finally agreed and implemented in reducing the incentives that firms have to engage in profit shifting. The revenue potential of this measure is significant as well. We estimate that at a rate of 15%, it is likely to generate somewhere in the order of $150 billion of additional revenue each year. Now, these revenue estimates are subject to all of the usual caveats, but it is a significant amount of revenue potentially at stake. So this is a significant step forward. If these rules can be brought to a final agreement in October, then and be implemented, they will, I think it's fair to say, represent the most significant renovation of the international tax rules in the last 100 years. They will, to a very large extent, bring those tax rules into the 21st century and to make them fit for purpose for a highly globalized, highly digitalized modern economy. Now, of course, there is always more work to be done, and we're not there yet. But we certainly are very encouraged by this important and significant step that we've observed earlier this month, where for the first time, more than 130 jurisdictions have signed up to something that is concrete in terms of what it proposes. There are still some issues to be resolved and some undetermined elements, but there is sufficient detail there to show that this train has left the station, and we are going to work very hard to get it to its final destination, which will be that significant renovation of the international tax rules. This will be significant. It will be important for countries like Australia. I think back to some of the early reflections that I had about what Australia could be doing, and we engaged in some unilateral measures back in 2012 because the rest of the world had not yet begun to engage in multilateral efforts. But what also became very clear to me back when I was Assistant Treasurer was that a problem that is so global in nature as cross-border tax avoidance, it cannot be solved by one single jurisdiction. And in fact, a single jurisdiction acting alone is only likely to put itself at some degree of disadvantage. And that's why collective action is necessary. And at a time when I look around and perhaps multilateralism has not always been the flavour of the month, I think this is one really significant area where tremendous steps have been taken forward at the multilateral level. And for my part, it's been a great privilege and a pleasure to have been able to play some role in all of that, but to also see up close and personal firsthand what that has involved. And stay tuned, and hopefully over the coming months, as we move towards October, hopefully we reach that final agreement. Hopefully we can bring even more jurisdictions on board to that agreement. We will have a detailed implementation plan with a view towards moving towards implementation through multilateral treaties, through domestic legislation where we would be producing model rules. And all of those elements give us the potential to be able to deliver what will be a very significant reform. So stay tuned, and I hope that we are able to realise all that we've been seeking to achieve. So thanks very much. Happy to leave it there and take any questions.
Okay, thanks, David. One of the disadvantages of this type of forum is that you don't get to hear the applause, which I'm sure if you've been in the room or watching us from Paris in the room, that would have been quite resounding. So, as I say, very unfortunate. If those listening would like to send through their questions, and then I can restate them whilst I wait for a question to come through. A couple come to my mind. Do you think that COVID has advanced the speed at which we've been able to progress these issues?
Yeah, look, I think it has played a role at a number of levels. Firstly, it slowed down the process, so that was a negative impact of it. But I think it has also brought into very sharp relief for governments some of the challenging financing decisions that they will have to take moving forward. And they involve all public finance decisions, from taxes to spending. And, you know, I think that for many countries, a recognition that, you know, there has been a problem here, it can be addressed. It may also produce some additional revenue, even if that's not the principal objective for undertaking the reform. I think that has played a role. I think the extent to which we've seen digitalisation accelerate through this period has also highlighted the urgency of needing to reform the rules to be fit for purpose in that new economy. Now, we went through a period there where many firms were really doing it tough and struggling and requiring significant government support, which in the main part was provided by governments. But at the same time, we saw some other firms doing spectacularly well because they operated through more digitalised business models. To have a system that is not providing neutral treatment across those business models, and then to see something like COVID exacerbate those differences, I think it really sharpened the attention of political leaders and finance ministers, and has given everyone a bit of a push along. I think the other element of all of this is that in the background, and I didn't mention this earlier, but in the background there was a lot of frustration from a number of countries that agreement could not be reached earlier. And that saw countries implement digital services taxes and other unilateral measures. And then we saw the United States retaliating through trade retaliation. And we saw the potential for this to just completely escalate into a full-blown trade war. And I think that, you know, if your options are getting back to the table and trying to nut out an agreement at the multilateral level, or continuing to go it alone, knowing that this is likely to escalate into something that is, you know, tantamount to a trade war. When you're thinking about those options in the context of COVID and the precarious nature of the global economy, you know, I think it would be very difficult for people to justify not going back to the table and renewing efforts to try and reach that agreement. But that said, as I said earlier, multilateralism is not something that has always been able to work as smoothly as we sometimes might like. But I think there really has been significant progress, in particular in the last 6 to 9 months, building on the technical work that had been done prior to that.
Okay, thank you. A question that's come through is, how does the Australian patent box proposal sit with OECD norms? Are you on top of that?
Yeah, so look, I must say, I haven't looked at the patent box proposal in any particular detail, but it is my understanding that the government has indicated that they intend that it will be fully compliant with BEPS Action 5, the requirements under harmful tax practices. So I wouldn't think that there would be any particular concerns on that front. But of course, whenever new regimes are put in place, it's something that they will always have to be considered in that context. But as far as I can tell, both in terms of the intent of the government, but also in terms of their desire, this would be fully compliant with Action 5. So I wouldn't see that as being of itself giving rise to any particular problems.
Good. From Chris Evans, can you elaborate on the determination of the tax base for pillars 1 and 2? In particular, do you see potential pitfalls in the reliance on financial accounting income?
Yeah, look, so financial statements will, to a large extent, form part of the base for tax determining the tax base. Now, these are challenging questions, but of course, if you want to reach some degree of global agreement, you have to converge towards some degree of commonality, whether it be financial statements with certain adjustments, or whether it be trying to identify a tax base completely from scratch. Given the heterogeneity of tax systems across countries, I think that the latter certainly presents all sorts of challenges. So, you know, it's in the context of trying to reach a global agreement where there are heterogeneous tax systems, but trying to bring about some degree of harmonisation in the way in which these matters are dealt with. Financial statements have been identified. Now, of course, on this issue, you know, there will be some adjustments that will be required, and there will be a considerable amount of technical work that will have to be engaged in, both for Pillar 1 and Pillar 2, to ensure that some of the potential risks associated with using financial statements can be mitigated.
Okay. From an anonymous attendee, do you think the arm's length principle is dead? Are the OECD moving towards a formulatory approach to profit allocation?
Well, I think one of the elements of the current approach is that Pillar 1 it operates in addition to the existing system, almost overlaid on top of the existing system. So the arm's length principle continues to apply in all other respects, but for the largest and most profitable multinationals, of which we estimate with a 20 billion euro threshold, a 10% profitability rate, which is what has been agreed, that at that level you'd be talking about somewhere in the order of around 100 multinationals. For those groups, this overlay on top of the system would also operate. But the arm's length principle will continue to operate. And indeed, one of the work streams identified, which is Amount B, which will not be agreed in detail by October, but will be future work to be advanced over the year ahead. Amount B is also about trying to make the arm's length principle in certain cases work more effectively, particularly with a focus on low-income and developing countries where they have less capacity in order to administer the arm's length principle. So, you know, I think it continues to live on. This will be a significant renovation of the system, but it will be an overlay to that system. Of course, this is something that, you know, if you had suggested we would even be contemplating a departure of the sort currently contemplated, if you'd suggested that 10 years ago, a departure from the arm's length principle of the sort that's being considered, I think most people would have said that that was never going to happen. They would have laughed you out of the room. So the fact that this discussion has occurred really has shown the extent to which the debate has progressed. And I think that it is worth noting that, you know, some of these issues have been given greater and greater focus and currency because of the broadening of the membership of the inclusive framework. That is an important consideration that I think is reflected also in what has been agreed in the statement that was agreed back in early July.
Yeah, definitely. There's been a move to adjust the tax treatment of royalties paid between companies in an effort to adjust taxable profits. How do these efforts sit with the OECD process?
Look, I'm not familiar with the detail of you know, the assumption of that question, but you know, to the extent that any efforts are undertaken on various tax measures at the country level, there'll need to be a full assessment of what the implications of Pillar 1 and Pillar 2 will be as and when they're agreed and when they need to be implemented. That's something that we've been saying to countries, is that you will need to review your tax systems. to ensure that in this new environment, if agreement can be finalised, that they continue to be the most appropriate set of settings. Now, there will be specific concerns of the sort that's been raised here, but you know, I'm not going to try and answer that without knowing the full detail of the premise on which that question is based.
Yeah, that's fair enough. And a great last question. What is an average working day like for you? And for those of us that are passionate about tackling avoidance, how do we find opportunities to assist and drive change?
Well, an average working day, difficult to, the simpler the better, I guess. I get up very early and I go to bed pretty late. And I spend a big chunk of it working with just a little bit of exercise in the middle. I guess for us, we spend, in the last 18 months, we've spent a lot of time on Zoom, you know, bilateral, multilateral, inclusive framework meetings. Now, these negotiations have been conducted with, you know, several hundred participants on a Zoom call. You know, that has taken some getting used to. And of course, we have to be on Zoom or Teams or whatever your tool of choice is, even for internal discussions amongst the team. You know, this is, I've spent a lot of time, more time in the last 8 months in front of a PC than perhaps at any other given point. So it's been very frenetic, very hectic. In terms of how people can contribute, look, there are a number of ways in which people can contribute to this work. There have been a number of public consultation phases to the process, and we always welcome contributions in that way. Sometimes there have been meetings which can be more difficult to attend if they're in Paris and you're coming from Australia, but some of those have been virtual as well. So that's also possible. I think through, we engage with civil society through some structured avenues. We also engage with the business community through some structured avenues. If people come from those sectors, there are ways through BEAC, the Business Industry Advisory Committee of the OECD, through TUAC, the Trade Union Advisory Committee, where you can feed in directly. But you know, I would suggest, if you haven't already done so, register to the OECD tax email alert. We send a lot of emails out, that's the downside, but you'll be kept abreast of those opportunities as and when they emerge. And of course, we also regularly advertise positions within the Secretariat, and that's something that you know, high quality candidates are always encouraged to apply for.
Fantastic, thank you. There are a couple more questions that have come through, but unfortunately we are out of time, so we can't get to them. We'll see what we can do about getting some answers across to the people that have asked. So that leaves me to thank you, David. What a fascinating, just hearing the journey of where we've been and how we're going to get there, and it seems that we are on the road to get there in the short to medium term at the best. Every time I do listen to you, it fascinates me, or I suppose really disappoints me, that OECD's gain is in fact Australian politics' loss, because I'm sure that you could have done a great lot of good in that particular role. So thank you very much for the lecture this evening. As I said, it's wonderful to hear the journey and exactly where we're headed and the great things that could come out of it. I'd also like to thank Pip for her introduction and the university for hosting this evening, and of course to thank Anne. And please do celebrate your amazing career, and we watch to see as you live and share with us all that's ahead of you in all the things that are left for you to do. So on behalf of everybody who's attending tonight, thank you all. Thank you in particular, David, for that great effort. Thank you.